Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I will be your host for about the next 20 minutes here on Options Guide TV. We're going to be short and sweet. We started out the earnings season by looking at a lot of trades in the Mag 7. They didn't work out as well. Came back most recently with the run up in the VIX. We had some really good trades in the VIX using butterflies, one of my favorite strategies. And now we looked at a trade in Walmart. And right now we have the retail sales earnings reports. Next week we have Target, we have Macy's, we have Lowe's. That's all going to be announcing next week. Walmart had strong earnings, and that's what we were looking for. So we did a bullish trade. Almost, there's no name for the strategy that we did, but to me, it's a FOMO trade, which means I might like to buy Walmart. Don't mind to do that if after their earnings reports, the market actually goes down and makes it, more affordable to be able to buy some shares of Walmart, just with an intention of getting bullish in that retail space. That's not a stock that I wouldn't mind owning. But oh my gosh, if you did buy Walmart ahead of earnings and then the stock went down, well, man, now you have egg on your face. So how do I buy a stock that I want to own heading into their earnings report? And the way that that's kind of the way I paint that scenario, because that was my thought looking into the trade that we put on. I don't mind selling a put on a stock that I would purchase ahead of earnings, but then you get that opportunity to bring in that premium from selling a put, saying that if the underlying market goes down to my put strike price, I'd be willing to buy 100 shares of it. But if earnings are good and the market goes up, well, then that opportunity is just missed. So I want to buy if it goes down. I want to sell the premium of the known event, the noon event, the news event, the earnings report, and I want to capture that premium. But what if I miss out on the opportunity? So and this is where I come in with the FOMO part of things, the fear of missing out. So I like to sell a put on the downside on a stock that I wouldn't mind buying around earnings, but then use some of those proceeds to actually pay for a call on the upside and give you some good leverage if you're correct on your forecast. If you do think they're going to have a good earnings report, you can do one of two things then. You can actually sell out the long call option and be happy with your profits and look for another opportunity to buy the stock at a different price now that that known event is taken care of. Or you can actually exercise your call option if you'd want to do that. In our instance, we're using the shorter term option contract. So either way would work out just fine. So let's go in and look at that trade, but keep in mind that the intention with Walmart is to just be bullish on Walmart. And the trade that we did was sell a short put spread to help pay for an out of the money call option. All right, so let's run to the TradeHawk software and let's look at how this whole trade played out. Okay, so right now we're looking at the call options on this side of the options grid inside the Tradier Pro software. We did the August 7th expiration, and that means that they are expiring today. The market at the time that we did the trade was 68.50, or at least when I took my screenshot, it was right around 68.50. We'll round up just a tad. And we sold the 65 strike put. Now, you could stop right there. That put was trading for 71 cents on the bid. And if you really want to buy the stock and you're not worried about the downside, that is a valid trade. You could sell it, say, I hope that the market comes down after earnings, gives me an opportunity to buy it lower. I'll bring in 71 cents for saying that I'll just buy it lower, and I'll put that trade on. Now, just as an alternative, I actually, and partly because there's Walmart just in general doesn't have a ton of implied volatility. You see, after their earnings report, they're actually down to an implied volatility of 17% on these option contracts. So it doesn't trade with a lot of vol. Even around earnings, it doesn't trade with a lot of volatility relative to high flying stocks, I guess. So 17% implied vol. So this option contract was cheap to buy a little bit of protection. So we sold the 65 and we bought the 63. So instead of bringing in 71 cents, we ended up bringing in about 35 cents. So we bought some protection. We took some of the premium. We bought some protection. We then went around and said, okay, so the market, remember, it's right around 68 at this point in time. It's right about here. And we said, well, I do feel bullish on Walmart. So let's actually take some of this credit and buy an option contract that's within the expected move of Walmart after their earnings report. And so then we went and bought the 72 strike call. And that on the ask price was trading for about 65 cents. Net, though, the whole trade, the whole gaggle of options, we got done for a net credit of 30 cents to the account. We sent it all in as one trade. We made sure that all legs executed at that price. But that whole thing was done for a small net debit of 30 cents. So we had the upside protection if the market took off. We had an opportunity to buy the stock if the stock went lower, is the way that I looked at it. And we had our risk hedged to the downside, that if the market did just completely fall out, that we had a protective put that we bought at the 63 strike. Now, in hindsight, if I was actually putting this trade on, 1 second, let me still battling my cold a little bit, so I'm get a tickle in my throat every once in a while. But in hindsight, I probably would have just sold the put, saying that you have a lot larger requirement in that you have to have the capital to put up the stock and buy 100 shares at 65 or $6,500. 100 shares at 65 if it got put to you. But I think I should have just sold the put instead of doing the put spread. I did something a little different. If I was in a more of a high flying stock, maybe if I was doing this type of trade, well, Nvidia would be a great example, right? They're going to be announcing earnings, and that's where everybody's mind is focused on. They announce on the 28th, which is a Wednesday, and Nvidia makes a lot of sense to do the trade this way if you wanted to buy in Nvidia, where you sold the put. You got so much premium because it's a higher flying stock. Much more expensive, though, obviously, to buy 100 shares of Nvidia than as opposed to, well, I guess it's not that expensive now that I think about it relative to Walmart after the split. So it's still expensive. It's more expensive, but it's not as expensive as it used to be. And if I'm got a high flyer like that, trading at a much higher implied volatility, I can see selling the put and buying some protection and then buying an out of the money call option. Everything's going to be relative to the implied volatility. So I think this strategy actually would work better for Nvidia if you're looking to try to buy some stock in Nvidia going into that earnings report. All right. Well, this trade worked out. That's bottom line. So let's go on. I guess we'll pull up the chart here in Walmart and we'll look at it. We'll zoom in on the area. So our high since their earnings reports, we've gotten all the way up to about 70. What day is this? This is on the 12th, 13th, and 14th. All right. So we got as high as, it looks like 70 almost after that earnings report. This doesn't make sense. Where am I at here? Oh, there it is. Yeah, that wasn't making sense to me. Okay, so we got as high as 70, about 74 and a half. Came all the way down. Now the market is trading around 73.50. So we did have more opportunity to be able to get out yesterday on that trade. And now we are trading within a range, and that still makes it a very profitable trade. So if you look at it, our option contracts that are put options, excuse me, our put options are expiring worthless, and our call option we could sell for 167. We put the trade on for 30 cents. We can sell it for about 180 right now. All right, so very solid, profitable trade. Oh my gosh. All right, so now next week we have Target that's announcing earnings, and we have Lowe's. I could see getting a little bit bullish on Lowe's. Target is a little bit more of a scarier beast as far as retailer is concerned. They do have exposure to the food marketplace, but not quite like Walmart. Walmart is, a behemoth when it comes to grocery. So Target's going to give a little bit more insight into the actual product side of things as far as the retail customer is concerned. So I'm a little bit more nervous about where they're going to end up. Target's chart does not look as good as Walmart recently either. So if I was going to do something on Target, I'd probably get a little bit bearish on the trade, honestly. And I would look to do something where I'm going to be just selling some premium outright, as opposed to here where this was a very bullish trade. And it did work out, obviously. Market was at 68. Now it's at 73, 74. Had an opportunity to sell it actually higher. It got up above 74. And now at this point in time, this trade works out at 178. So let's look at Lowe's. They're going to be announcing before the open. So they're going to be announcing before the open on Tuesday. And so we will have an opportunity to look at that trade. Now, it's a little bit more expensive stock, so we add a little bit of premium into our trade. Yeah, it looks like Tuesday before the open. And the marketplace is showing me that the implied volatility is at 31 now on the August 16th, today's expiration, and the August 23rd expiration is 41. And so we're trading right at about 240 on this trade. So if I look at this, I don't mind putting together a butterfly on this trade going into that earnings report that's going to be at the end of the week. We're going to buy the 250 strike option contract. And sell 2 of the 80s. And then we're going to skip. This is going to be a real small a butterfly that we're going to put on. Skip the 250s and buy the 260s. So, 1 second. Okay, try this again. So using this expiration date, I'm just going to look at doing, we're going to look at doing a butterfly that's going to give us some upside on this trade. We're not going to look at the skip strike. We're going to look at adding a butterfly that will benefit us on an upward move in Lowe's. And man, I can't stop coughing. Wow. And give us some upside. If the market goes up, we'll put a little bit lower cost than buying the call option outright, but then will benefit us if the market does take off and skyrockets to the upside. So here's the way the trade's going to get set up. I'm going to struggle through this and see if we can get there. I do see we got a comment. Thank you, Patrick, on the Walmart trade. And like I said, the Walmart trade is interesting. I call it a FOMO trade. There's never been a name that's given out for that strategy. But if I had to do it over again, I would look at it because I do like Walmart. I don't mind owning some of the stock. And I think I would just sell the put outright as opposed to selling the put spread. I think selling the put spread would make more sense if you want to do that on NVIDIA going into their earnings reports. You want an opportunity to maybe buy some more of that underlying stock. Your opportunity was missed if you wanted to buy it at 100, right? That opportunity is already sailed on that downturn. But if you want to try to get long NVIDIA going into earnings, it's a very interesting way to do that. We got one more week away before we start talking about NVIDIA and their earnings. Okay, so I'm back in the saddle. Here we go. Let's buy the 245 strike call. So now buying that outright is too expensive to me. I do not want to pay $3.30 for an out of the money option contract with 7 days remaining and pay that much premium, even though implied volatility isn't ridiculous, trading right around $41. So here's the way that I'm going to approach this. I'm going to buy that call option. We're still within a 1 standard deviation move. So if we even look at, if we just buy the at the money straddle, we buy the 560 strike call, and let's call it the 560 strike, or the 240 strike call and the 240 strike put. Let's call it $11.50, right? So that's the expected move. So $51 is within the range. It's all feasible to be able to land within that range. Now, so if I'm buying an out of the money call, I'm going to stay between there. I want that option contract to get into money. So the 245 strike call is feasible. The 247.50 strike call is feasible. All right, but so then you come around and you say, well, maybe I'll do a call spread, right? If the expected move is $11, that means that they don't expect it to go much higher if the forecast is good, or if the earnings announcement is perceived as good, than 250. So maybe I sell the 250. Don't mind that. Now I'm going to take it one step further though and say, okay, I'm going to do that and stay within that move, but I'm going to bring in some more premium. That's still too much money to deal out here. So if I sell this one, we're still talking about $1.56. So let's get it a little bit cheaper, but still give ourselves some upside if it continues on up. Okay, so here's the trade that we did in the VIX options, but we did it using put options. So here's what we're going to do. We're going to add 2 of these. So this would be the start of a standard butterfly. If we went 5 points out to the 255, well, in that instance, then we would just have a standard butterfly. So let's do that, and I'll remove that leg then later. Okay, 62 cents. Simple to do, but the market's got to stay within 10 points. It's got to stay within 245 and the 255 strike. They got to stay within our wings. Don't like that as much, right? That's tough to do after earnings. And also, they're announcing on a Tuesday, and the options expire on Friday. Too many days, too much time decay. Decrease in implied volatility would help if you're correct, but no. Okay, so here's what we do. Here's how we adjust it. And this is what I would consider an actual broken wing butterfly. 1 second. Let me cough again. And so let's remove this leg, the 255 strike, and we're going to add this one. So we're going to buy a more expensive option. We're going to add some cost to this trade. So still cheaper than buying the calls outright. If we bought this call, that's 257. We bought this call, it would be 237. Buy even the 250 strike call, saying that right at the end of the max of the expected move, you're still paying $1.87. The spread was $1.50 to get a 5-point wide spread. So that's also expensive. Not bad. Don't mind it doing the long call spread. But now this butterfly, we got the cost all the way down to $1. We still have the benefit if it does do the expected move and stands right around that 250 mark, which that's what we're targeting. If that does happen, we're still good. We're still good on this trade. But if it continues on up, we do have some upside. So we got a home run scenario right at 250. From 250, 250 on up, we have limited and known upside. So here's how it looks if we send it to the what if calculator.
Brian, you're still muted, and I can unmute you.
Okay, oh, wait, sorry, I did not unmute from that last coughing spell. 239.72 is where the market is at. Expected move is 10 points, right? Right about here, right where our precipice is on our butterfly. And I can zoom in on this a little bit too. But if it goes all the way up to here, we can still make 149 on this trade. We pay what was it? 45 cents more than the standard butterfly. But by paying that extra amount of premium, we say anywhere if Lowe's blows the doors down after their earnings report and the market runs all the way up to 260, we still have the potential to make $1.50 on the trade, or $150 for every 1x2x1 butterfly. So we actually broke the swing, right? Skip strike butterfly to me means a credit. A broken wing here means that we're gonna pay up more than the standard butterfly, but we're gonna say, if I am bullish on Lowe's going into earnings, and I look at the marketplace and say, okay, the expected move by this earnings date is $12, and it's trading right at two. That's with a market right at 240. Well, it's more closer to 11, but if we do that, then this trade is very feasible, as opposed to an outright bull call spread, an outright bull call. This is not a bad way to trade this. Now, totally different than Walmart. I don't want to own Lowe's. I'm not trading Lowe's. I don't think that it's a horrible company. You know, they got a duopoly with Home Depot. I don't mind the underlying, but this is a pure just earnings play, hoping the retail customer is still strong and they have a strong move going into their earnings report. And there's the trade. Man, I struggled with that. Sorry about that, everyone. If you got any more comments, Patrick, I appreciate your comments. You got to admit that this is an interesting trade too, just from looking at the what if calculator. There's no doubt. And we'll come back next week on Monday, and then we'll look at the strategies for the upcoming trades, NVIDIA trades at the end of the week next week. Apologize for I'm still battling with the little bit of cold that I got last week. So we will be back on Monday, 11 a.m. Eastern time, for the next edition of Options Guide TV. Hope to see you there. And then on Tuesday, we'll have this earnings announcement in Lowe's. Thanks for coming.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.